You have a set amount of capital ready to deploy, and you are looking at two highly profitable companies operating in the exact same industry. The dilemma is deciding which one actually deserves your money. Looking at a company's raw total profit provides an incomplete picture. Because corporate structures are scaled differently, comparing a company that makes $10 million to a company that makes $5 million tells you nothing about the actual value being delivered to the individual owners. Evaluating a company based on its stock price is equally flawed. A $10 stock is not inherently cheaper or a better deal than a $100 stock. Relying on the sticker price alone leaves your capital highly vulnerable. This equation levels the playing field. Dividing total profit by outstanding shares calculates earnings per share, or EPS. It scales corporate revenue down, isolating exactly how much profit is generated by a single unit of ownership. We are going to test two companies using raw EPS, factor in the reality of what the open market is currently charging for those shares, and isolate the financial engineering that management teams use to inflate their numbers. Making an investment choice without calculating EPS means you are operating on market illusions. We need mathematical truth. This comparison matrix sets up two competitors. Both secured $10 million in profit. Company A operates with 5 million shares, while Company B has 10 million. Company A divides its profit by those shares, netting out to $2 of earnings per share. Company B spreads that exact same total profit across twice as many shares, resulting in an EPS of just $1. For every share you hold in Company A, you own double the profit-generating power compared to an identical investment in Company B. But grabbing shares of Company A immediately is a massive risk if you stop here. The open market knows Company A is highly efficient. If sellers are demanding an extreme, unjustified premium to buy those shares, that strong EPS loses its advantage. Raw EPS tells you the horsepower of the business engine. It completely fails to tell you the price tag of the vehicle. This equation provides that missing context. The price-to-earnings ratio, or PE, is the essential companion to EPS. It calculates the exact dollar amount you have to spend on the open market today to purchase one single dollar of that company's profit. A high PE ratio indicates buyers are willing to pay a premium. They are accepting an expensive entry point because they expect massive earnings expansion in the near future. Buying at a high multiple leaves zero room for error. If the company misses those optimistic growth targets, the market corrects aggressively and your capital takes the hit. Conversely, a low PE ratio means a cheaper entry point. It requires less upfront capital to secure the same dollar of earnings, reducing your initial risk. But a heavy discount often signals deep pessimism. The market might be pricing in stagnant business growth, a heavy debt burden, or structural problems within the business. Protecting your capital requires finding a strong EPS attached to a PE ratio that reflects reality, ensuring you do not waste money on overvalued hype. A single year of data is a static snapshot. To successfully confirm a business is actually expanding its footprint, you have to evaluate a consistent multi-year EPS trend. However, while you map those years of profit, you must rigidly track the total number of outstanding shares. Failing to monitor the share count leads directly into the ultimate valuation trap for investors: share buybacks. This dual-axis chart shows exactly how a company can artificially inflate its numbers. Total profit remains completely flat, but management aggressively buys and retires its own shares. Because the share count shrinks, the resulting EPS spikes aggressively upward. You must distinguish between organic growth, selling more products and services to customers, and engineered growth, which relies entirely on financial manipulation. Buying a rising EPS driven solely by buybacks masks a stagnant business. It traps your money in a company that is not actually expanding. Heavy share buybacks also drain cash. Every dollar spent retiring shares is a dollar removed from real-world reinvestment or geographic expansion. True financial health demands evidence that a rising EPS is driven by an expanding business, rather than a shrinking share count. This quadrant chart maps out how different investment goals require entirely different EPS profiles. Consider the dividend and value investor, who prioritizes capital safety and generating a steady, predictable income stream. This goal matches mature, established companies. They typically exhibit a steady, flat EPS and a low PE ratio. Because they have already conquered their market share, management uses that steady earnings power to fund regular cash dividends directly to shareholders, rather than hoarding capital for massive expansions. Contrast this with the growth investor, who needs the baseline value of their portfolio to multiply over time. This profile targets companies demonstrating rapid, multi-year EPS acceleration, which naturally commands a higher PE ratio. The core trade-off here is clear. You accept higher stock volatility and a premium price tag in exchange for capturing that future expansion potential. There is no universal best company to buy. There is only the mathematical profile that aligns with your specific timeline and risk tolerance. This dashboard highlights a scenario to avoid entirely: companies reporting a consistently negative or declining multi-year EPS. Unless you possess highly specialized insider knowledge of a corporate turnaround strategy, deploying capital into declining earnings is reckless. Your evaluation framework is straightforward. EPS measures the horsepower, the PE ratio assigns the price tag, and the share count proves if the growth is real. Ignore the flashy stock prices and market hype. Rely on rigorous, contextualized earnings data to drive your decisions. Successful investing is never about guessing. It is about confidently allocating your capital exactly where the mathematical reality matches your strategic mission.